Let's jump right in. Today, we're putting Sally Beauty Holdings, ticker SBH, through the absolute ultimate valuation gauntlet. We're going to strip away all that daily market noise and just look at the raw data together. We'll be running this stock through the strict, time-tested frameworks of investing legends like Warren Buffett, Peter Lynch, and Benjamin Graham, plus a rigorous discounted cash flow model to find its true intrinsic value. So let's see what the numbers actually reveal. Here's our roadmap for this explainer. We'll start with a quick company snapshot, run it through the Guru Gauntlet, crank out a DCF valuation, look at some alternative valuation models, and wrap it all up with a synthesis and final verdict. All right, Section 1, Company Snapshot. Shifting gears. So Sally Beauty operates as a specialty retailer and distributor of professional beauty supplies. Right now, it's hovering around a price of $13.83. But the real story here in the source material is their massive shift in strategy. Management is deliberately pulling back from expanding their physical footprint. Instead, they're entirely focused on optimizing the stores they already have to drive efficiency. Basically, they're betting the house on profitability over aggressive top-line growth. And taking a look at their Q2 2026 baseline health, we've got some really solid data to work with. Net sales are sitting at $903.4 million, which is actually up 2.3% year over year. Net income is $42.7 million, but the standout number? They are generating a robust $163 million in trailing 12-month free cash flow. Combine that with roughly 95.8 million outstanding shares and total equity of just under $838 million, and we've got the raw materials we need to start running our gauntlet. Moving on to Section 2, the Guru Gauntlet, testing the legends. Let's start with the Oracle of Omaha himself, Warren Buffett. Buffett is always hunting for an economic moat, which SBH definitely has through its specialty retail dominance, even though it's taking some heat from digital shifts. He also loves consistent earnings, and SBH absolutely delivers there with an incredible 51.7% gross margin. Plus, their return on equity is a stellar 24.4%, which is a massive green light. But then we hit the debt. With a debt-to-equity ratio of 1.62 and long-term debt sitting well over $800 million, their overall leverage is quite high. For the Buffett framework, that is a glaring red flag. Now, the crucial next step is calculating Buffett's famous owner earnings. Because specific maintenance CapEx wasn't separated out in our source financials, we have to make a reasonable assumption. We're using that reported trailing free cash flow of $163 million as our closest, most reliable proxy for what a private owner could actually pocket from this business year after year. So, the big question, would Buffett actually pull the trigger at $13.83? Honestly, given his strict demand for a conservative margin of safety and a totally clean balance sheet, he'd probably pass right now. That high debt load is just a really tough pill to swallow, even though that $163 million in cash flow translates to a highly attractive 17.3% free cash flow yield. Let's shift gears over to Peter Lynch. Lynch categorizes stocks right off the bat to know what he's dealing with. Given an analyst projected revenue growth target of around 1.7% annually, Sally Beauty fits perfectly into his stalwart category. It's not some fast-growing tech darling, it's a mature, predictable, cash-generating machine that you buy for stability and underlying value. Now, check out their PEG ratio. That's price to earnings divided by the growth rate. It sits at a phenomenally low 0.64. Lynch loves absolutely anything under 1, so SBH passes that test with flying colors, screaming cheap. Its PE ratio is also just 7.64, well below his threshold of 15. However, just like with Buffett, SBH fails Lynch's balance sheet check because of that debt-to-equity ratio of 1.62. He'd likely view this as a cautious buy or hold while keeping a very close eye on management's ability to pay down that debt. Enter Benjamin Graham, the godfather of value investing. Let's run his incredibly strict defensive investor checklist. Adequate size with over $3.7 billion in revenue? Pass. Earning stability? Pass. Moderate PE? Passes easily at 7.64x. But it does fail his dividend record check, since SB&H doesn't pay one. They prioritize share buybacks instead. And it slightly overshoots his rigid price-to-book limit of 1.5, coming in at 1.58. But Graham was fundamentally a math guy, so let's look at his intrinsic value formula. From our sources, we derive an EPS of roughly $1.81 based on the current PE and price. For book value per share, we divide the $837.87 million in equity by 95.8 million shares, getting $8.74. We plug those directly into the formula to uncover the hidden math, the square root of 22.5 times earnings per share times book value per share. And the math reveals a gram intrinsic value of exactly $18.86 per share. Think about that for a second. At the current trading price of $13.83, this formula implies a massive 26% margin of safety. While the initial checklist wasn't totally perfect, Graham, the pure value hunter, would be highly intrigued by this kind of discount. Section 3, Discounted Cash Flow Valuation. Stepping away from the gurus, let's build our base case DCF. We take that $163 million free cash flow baseline and apply management's 1.7% growth target for the forecast period. For the terminal value, basically what the company is worth forever after, we assume a highly conservative 1.5% growth rate, which is a standard retail industry proxy. Finally, we discount those future cash flows back to today using an estimated 9% weighted average cost of capital, which accounts for the risk of their debt load. Running those numbers gives us a base case fair value of $18.80 per share. What's fascinating here is how closely this aligns with the $18.86 we just got from the Benjamin Graham formula. Plus, it directly matches the analyst's consensus fair value highlighted in our source data. Now, let's look at the sensitivity of this model. Even if we hike our discount rate, the WACC, to a very punitive 10% to account for extra risk, and we drop terminal growth to just 1%, the fair value still sits at $14.80. That is still comfortably above the current $13.83 trading price, showing us that a ton of market pessimism is already priced in. Moving to Section 4, Alternative Valuation Models. Looking at comparable multiples, it's pretty clear the market is treating this stock like a clearance sale. Their enterprise value to EBITDA ratio, which measures total company value against its core cash profits, is just 7.03x. That, along with a price to earnings of 7.64x, signals heavy discounting. But that price to free cash flow multiple of 5.77x is just wild. It implies a nearly 17% free cash flow yield. You rarely find that kind of cash generation priced this cheaply unless the broader market expects the underlying business to completely evaporate. And here's a really striking comparison. While our base DCF points to a realistic $18.80, alternative asset-based models in our source data suggest that if you evaluate the raw earnings payer value, meaning the value of the current earnings indefinitely, completely ignoring any future growth, it could mathematically justify a value upwards of $63.17 per share. That shows the massive potential upside if management can successfully protect those existing cash flows. Finally, Section 5. Synthesis and final verdict. Across the board, all this data tells a remarkably consistent story. Whether it's Graham's strict formula at $18.86, our baseline DCF at $18.80, or the more aggressive scenarios pushing up into the high 30s, the calculated intrinsic value consistently lands well above the current market price of $13.83. But as analysts, we really have to weigh the realities here. The tension is obvious. On one hand, the key strengths. You're buying fantastic cash flow, high return on equity, and successful margin expansion at a very steep discount. On the other hand, the key risks. You are taking on a highly leveraged balance sheet with that $1.5 billion in total debt, and you're betting they can survive declining store traffic and a rocky transition to digital retail without their margins completely collapsing. So, what's our final impartial verdict for this explainer? Blending the insights of Buffett, Lynch, Graham, and our DCF, Sally Beauty is a mathematical value buy at today's price of $13.83, with a clear target value of $18.80. The margin of safety is absolutely there. But I'll leave you with this ultimate provocative question. In the brutal world of modern retail, can ruthless optimization truly replace the need for top-line growth? Let me know what you think.